Hello, and welcome to Module 17, where we're going to talk about bank liabilities. Last module, we talked about assets, and we looked here at Abacus Federal Savings Bank balance sheet, where we have the total assets with the largest asset being loans. And if we come down to liabilities and capital, we see that on the liability side, deposits are the most common liability for a very traditional bank. Now, if we want to compare what a larger institution such as Chase, we can go back and do the same thing for Chase here. Just put in Chase's name, do this for the details, we go to the financial information, and we can generate a report. And you can do this for your own bank. If we look here at total liabilities and capital, we still see that deposits are by far the largest liability, but we do see a bit more interesting kinds of items in the liability. But where we really see the difference is up here in the assets, where although the loans are important, there are really a large variety of other types of assets. But it is interesting that all of this information is available, but yet I think quite rarely accessed. And that will tie into our next module on FDIC insurance. But leaving these balance sheets and getting back to our PowerPoint on the deposits and the liabilities, we are going to focus definitely on the deposits as the most common liability for a bank, because they accept the money and they have to pay it back, typically on demand or with some small amount of kind of notice, which is rarely invoked, but oftentimes in the agreements for certain types of transactions. So demand deposit accounts are the transaction accounts, basically the accounts that traditionally checks were drawn on. What is sort of interesting is that they were contrasted with savings accounts, which had no check writing privileges. But what we see is that now with electronic transactions, the difference between savings and demand deposits is quite different. And part of that is because now that you don't use checks, you can move money from your savings account really the same way you can move it from your transaction account. And the other big change is that traditionally the federal law prohibited more than 6 transactions per month out of a savings account. But that was removed in 2020 during the pandemic. Now, I would say most financial institutions still keep some type of limit. They oftentimes limit it by method, maybe unlimited in person, but electronically. It's really for kind of stabilizing deposits. With the movement of money electronically, deposits are less stable. I could, at the end of this recording, go check deposit account rates and move all of my money. And that has really changed the nature of deposit accounts and the competition. Now, the final type of time deposit, which had become very unpopular, are the CDs, because the rates have been so low, but they are now a bit higher. So they are definitely gaining some popularity, particularly for those who had seen sort of below the decimal point interest rates, now seeing interest rates above 5%. But the main difference is the contractual arrangements and the laws that apply. So it's really always a compliance issue. What kind of account are you offering, and consequently, what laws apply? An account that's referred to in your reading are these lifeline accounts, because there is an ongoing concern with getting everyone in society into the banking system. And by having a lifeline account, which is an account with few or no fees, it's a way to get low and moderate income people into the system so that they don't use more expensive alternatives such as check cashers and maybe money orders. So in 2021, which was the last time the FDIC did the study, there were only 4.5% of Americans who did not have some type of a bank account. And that's the lowest level they've seen since they've been studying this topic. And so the Lifeline account is something that the banks will offer. And in a way, it can help their Community Reinvestment Act, which we will talk about, to show that they are reaching out and serving the underserved parts of their community. Another type of account that I just mentioned were the certificates of deposit. Those are the accounts where the depositor agrees to leave the money in. It can be 4 months, 6 months, 5 years, and they get a substantially higher rate of return, but the money is there, and there's a substantial penalty for early withdrawal, which can be 3 months or 6 months of interest. And so it's really a very safe place because of the FDIC insurance to put your money, but it's not particularly liquid. Now, on the deposit side, the federal law that regulates the disclosures is called the Truth in Savings Act, and its details are in Regulation DD, which has been moved to the Consumer Financial Protection Bureau. Now, when we talk about credit disclosures, we see that they're a little bit more complicated because there's a lot of potential risk in someone not understanding a credit transaction and also being charged a lot of fees. On the Truth in Savings side, it's a little bit streamlined. Basically, the rate information, which if you're familiar with loan rates, they're called the annual percentage rate, APR. And on the savings side, it's the annual percentage yield, APY. So if you look at some advertisements, you'll see the difference, hopefully. The compounding and the crediting of interest has to be disclosed because that can make a big difference over the course of a year. Any kind of required balance information to open an account, to avoid certain fees or to get a certain interest rate. Of course, you always have to disclose fees at the transaction limits. Any type of CD account has to explain that. And what's sort of interesting is the bonus idea. I've been practicing in this area for a long time and I've never seen bonuses, but bonuses have really come back. And that's when you can get, a couple $100 for opening a savings account. Those all have to be disclosed, and particularly how long you must leave your money in without having to give back that bonus. But anytime we have a disclosure requirement, what you have to remember is we have essentially a legal contract, and we also have a compliance issue. And so that was in part the nature of our case that we read, the Garcia Harding case. Because in this case, although the case itself is a whistleblower sort of discrimination case, what's important to us from our compliance perspective is that we have a situation where we have a bank that is promoting, and their disclosures presumably say what they're promoting, which is that they have no minimum balance and no waiting period for ATMs. At a particular branch, the branch manager is instructing the tellers that there's a $100 deposit requirement to open an account and a 30-day wait for ATMs. And so this really drives home an ongoing compliance challenge, which is, do the written disclosures and the written contracts line up with what is happening? And particularly, anytime you have individuals and you have branches, is there the right training? This arose in the context of training. Are the managers understanding what the bank's policies are, and are they conveying those to the actual tellers? And so it's very important for compliance and legal to always be involved in employee training, the writing of disclosures, and the writing of advertisements. So as I said, this case really, really illustrates, essentially someone could bring an action, even a contract action, that they had not been given the benefit of the bargain. In this case, it also appeared that there was discrimination. That, of course, should be another subject of training and auditing. But, it's really important that you're not just sort of doing compliance, I guess, off at the main office, that the compliance auditing goes all the way to any place that customers interact with a bank employees. One of the things that we have seen as there have been sort of more restrictions and laws on the loan side is there was a time when banks were realizing that deposit fees was a good place. People, maybe they don't understand them. And so there are all kinds of fees that can be imposed on deposit accounts, and it's pretty easy to get them because the bank's already holding the folks' money. So anytime there's a stop payment, those fees are typically at least $30. Overdraft fees were becoming a huge profit center for banks, although they've almost been eliminated. The bank regulators have become very down on overdraft fees, and the laws have changed some. And one of the things that I have seen is that in some of the bank exams, the banks have charged the account holders overdraft fees when accounts are overdraft, and they're all automated. All of this is automated. And so consequently, there's not a good record of what is happening. And all they know is there was an overdraft, something was presented for payment, the money wasn't there, a fee was imposed. Well, what can often happen nowadays in the system that we have is a check, or basically an ACH, is returned unpaid and it's represented. And so what's happening is multiple fees are being charged essentially for the very same payment. And the bank regulators are, they're not, they say that is unfair and that is not appropriate. And what I've seen is that many banks cannot really establish why they charge the overdraft fees, other than that something was presented and the money wasn't there. And if that's the case, what I see is the banks refunding basically all the overdraft fees for a several-year period. So it is a compliance issue because everything became automated and the records just weren't there. Account maintenance fees have become more popular if you don't maintain a certain balance, unless you're trying to offer a lifeline account. We see more paper statement fees, and activity fees were another area that banks were trying to make some money. Got a lot of bad publicity, so not really seeing those. The return item fees, somewhat like the overdraft fees, although more related to, I guess, a paper check. But in general, we see a lot less regulation of fees on the deposit account side, which is why the banks have felt pretty confident in imposing these fees. And even when we have these challenges to the fees, they tend to be on a UDAP basis, that the fees were unfair. That's sort of the overdraft problem. Not that they are illegal per se, but that they're unfair if someone keeps representing the same request for payment, and then they just get hit with multiple overdraft fees for essentially one payment request. There is a federal regulation that goes with the National Bank Act that basically says a national bank may charge its customers non-interest charges and fees, including deposit account service charges. And so this is a very sort of sweeping authorization. And again, why the banks feel pretty comfortable opposing these deposit account service fees. It does point out that charges and fees that are interest under Section 85 and 7.4001, which is our whole discussion of usury preemption, are not these deposit account service fees. So a fee must either be under the interest side or a service charge, non-interest fee. And the regulation, just like we saw on the credit side, says that the OCC applies basically the general preemption principles. I did ask you to look at a note that related to this preemption of deposit account charges, and that was on page 509, the note or comment number 8. And it was talking about some challenges to banks that were charging customers, or they were charging customers, if that's your view of it, a fee to cash a check if they were not account holders. And the National Bank said, 7.4002 says we can do this. We can charge our customers a non-interest charges and fees, and we're charging them fees to cash checks. Well, the consumer advocates say, well, these aren't your customers, so this regulation doesn't apply. In fact, that's why you're charging them the fee. The courts ultimately held that the individuals are customers, not account holders, but customers because they are requesting a service, check cashing. And consequently, they found that in that case, the state laws that prohibited check cashing fees were preempted. And so it was determined that national banks at least, can in fact charge non-account holders fees to cash checks. The other part of that same note talked about fees that were being charged to cash payroll checks. And this was in California, which is very, very strong consumer advocacy. And in this case, it's the intersection of labor laws, which say people should be able to get paid without any fees or deductions. And banks were charging fees for non-account holders. Now, this didn't go to court. In this case, it says there was a settlement and they agreed to, and this was the case where the check was actually drawn on the bank. So it was a non-account holder with a payroll check drawn on the bank being charged a fee to cash that payroll check. And so it said here that the bank agreed to cash those payroll checks if the payroll check was in an account at the bank, essentially because there's a real lack of risk in that situation. So it illustrates that there is a lot of authority for national banks to charge these fees, but again, it's not without limit, and there can be laws that apply outside the banking context, such as employment laws when you're dealing with payroll checks. 7.4002 does lay out some rules for establishing the fees and what the amount should be. One is competition. Another is the cost incurred, which is very interesting because for many of these items, the cost incurred is infinitesimally small, particularly as everything is done electronically, which is why one of the other factors, the deterrence of misuse, becomes so popular. That, if you overdraw your account, you are breaching your agreement. So that's why you're charged a fee that is far greater than the cost incurred. And again, there is some risk if the check is large. The enhancement, again, of competition and safety and soundness, which is kind of this ongoing concept, which means good banking practices. We also read a case dealing with this dispute over sort of what is and isn't a deposit service charge. And I think this is an interesting case. This is a business checking account holder who was charged an overdraft fee. And what this person alleged was that if you change this overdraft fee into a credit fee, so for example, if someone wrote a $100 check and it bounces, and they're charged $30, and the next day the money's back in the account, if you treated that as a $100 loan with a $30 fee, that would be a huge rate of interest. So the real question is whether 7.4001, the national bank regulation that applies to credit, and which expressly authorizes not sufficient fund fees, if that is what applies when a check is overdrawn. And so the real question is, when a bank honors an overdrawn check, is that actually an extension of credit? Which it's not a ridiculous position, really. They are advancing money, and that is, in fact, what credit is. But what we oftentimes see the courts looking at is that they look at the contractual arrangement. There is no contract for credit. There's no agreement. Essentially, it was a deposit account. That's what they said. The person breached the deposit account. The bank went ahead and honored the payment instrument, but that is still a deposit account transaction. And it is governed by 7.402. It is not interest on a loan. And consequently, the fee that was charged was reasonable. But this case and some others like it at the time really brought to the forefront this idea as to, what is going on here when a bank, honors your overdrawn payment instrument. And Does the customer want that or not? And so now the area is far more developed in that a bank can and will offer an overdraft line of credit, and that is a credit account. You will get loan disclosures and understand all of that, and that would be agreed to though upfront in advance. The customer must say, I want to have an overdraft line of credit because I don't ever want to have a check not gone through. Also, a customer could have a secondary account that money can be drawn from. And another part of the regulation that was developed after that case was that a bank should not agree to always honor an overdraft, that they can do it on a discretionary basis. But if you agree to always honor it, that looks too much like credit. Then you need to make it an overdraft line of credit and you need to give credit disclosures. Another option that came out of all of this is that customers should really get to choose, because some consumers said, well, I don't like to keep track. And if I write too many checks or initiate too many ACHs, if I don't have the money, I want them declined. And so essentially, customers can now say, I don't want you to honor my overdrawn payment requests. And so the landscape has really kind of changed in the last 20 years as it's been more developed, that really what the bank does needs to be disclosed to the customer, and the customer needs to have some choices in all of this. Part of why all of this has happened is because both ATM and point of sale debit card transactions became so much more popular. When you had to write out a check and you potentially had a check register, and you also had that delay in processing paper, there were not nearly as many overdrawn transactions. And so more recently, Congress has stepped in, and they've basically said that customers need to have the ability to opt in to the bank honoring these ATM and point of sale debit card purchases. And if the bank is going to charge a fee, they must disclose it to the customer, and the customer must agree to it. And if they don't do that, then they can't charge a fee. Now, the bank could always honor the transaction at their option, but they can't charge the fee if they do not get the person's consent. And that is a big part of what we see in this area, is the idea that customers should ultimately have the choice, particularly if it's going to charge them. The bank is going to charge them for the transaction. This also relates to a note that was on, I think it's page 508, note 6. There was a lot of litigation at one point, and again, this was at the rise of the use of ATMs and debit cards, where banks started processing all the transactions that came in a day from high to low, which would mean, let's say you have a mortgage payment, and then maybe you have a car payment, that might be your second largest, and then maybe you bought a pair of shoes, and then you had a coffee, and then later in the day you had a second coffee. Well, what was happening was, by processing that mortgage payments first, a person might be having 3 or 4 overdrafts in a single day. Whereas if they have been processed with the 2 coffees and the shoes, and maybe even the car payment, there would have only been 1 overdraft. That would be the mortgage payment. Well, the bank said, hey, we're just trying to help you. Nobody wants their mortgage payment declined. And the customer said, you're not helping me. You just charged me over $100 in fees because I got 2 cups of coffee. Anyway, a lot of litigation, and ultimately the cases were not going in the bank's favor, although their agreements were very wide open. It was found to be unfair and unexpected. And so there were some pretty large settlements by some of the very large banks. So we see that a lot of the agreements are either more explicit, or transactions are being posted more in the order they come in a day. But the high to low posting has pretty well been established to be unfair and unexpected. So this was just some of the issues that come up with the deposits, which are the biggest liability for banks. And in our next module, we'll talk about the FDIC insurance, which is really, as we know, kind of a key aspect of banks and why businesses and consumers continue to put their money in the bank. So please reach out if you have any questions.